Good afternoon, everyone, and welcome to another Australian Shareholders Association webinar. My name's LICAT. I'm the Chief Marketing and Education Officer with the ASA, and today it's my pleasure to welcome Ian Irvine, the CEO of LICAT, and special guests Emma and Miles for a great interview about global activist investing and scouring the globe for investments trading at a discount. I don't want to dive into the topic too much. I'll leave that to Ian, but before we get started, a little bit of housekeeping. If you have a question for the team today, please use the control panel. You'll see a questions tab. You can type out your question, and at the end of the presentation, I'll be back to help ask those questions to your panel today. Of course, the disclaimer, anything that is mentioned today is for education and information purposes only. Nothing is to be considered advice. If you're interested in anything you hear today, please do your own due diligence and consider consulting a professional. With that out of the way, I'd love to hand it over to Ian. I'll get off the screen, and Ian, over to you. You can take control and go ahead with this wonderful interview.
Great, thank you so much, Lee. Welcome everybody. As you heard Lee say, I'm the CEO of the Listed Investment Companies and Trusts Association. It's great to be back with you again. We've done a couple of webinars, and in particular, thanks to those of you who were able to join us at the Investor Conference earlier on this year in May. Great feedback from our panel discussion there about the educational aspects of listed investment companies and trusts. And that's what we're here again to do today, just to continue to demonstrate the breadth of listed investment companies and trusts. But we're talking about activist investing, so there's every good reason to meet with and listen to, seated on my right, an entity that has a global focus on investment, looking for finding investment companies and trusts that are trading below the net asset value, working with those inside those organisations to bring value to both the shareholders of the organisations themselves, as well as the investors that invest alongside Emma and Miles in the ASX listed investment company, Global Value Fund, GVF. Emma is actively involved alongside portfolio manager husband Miles Staude, who are seated with me, as I said, in operating GVF. So I'll be interested to hear how that plays out on a day-to-day basis, as well as importantly how the LIC structure at GVF contributes to the long-term investment thinking and investment outcomes. Emma, if I could start with you and Miles. Thanks for joining us today. Congratulations on the growing family. I know on the home front, the family unit's increasing. I believe you just added one more to the family.
A third, yes. We
never
learn.
It'll be interesting to hear more about the growing family, how that sits alongside a growing investment fund. Emma, as I said, can you get us started with providing a little background on GVF? I believe that while we're listed investment companies listed here on the ASX in Australia, you've operated out of the United Kingdom, and in fact your head office is in the UK. So paint us a little picture about how GVF sits and how it looks.
Yeah, thank you, Ian, and thank you to everybody for listening in today. Really appreciate the time. Yes, so we have just had our third child, so growing the family, we never learn. But yes, as well as growing a family, we're also growing a listed investment company on the ASX. Miles and I are married, just to clear that up.
Please use all disclosure. Yeah, full disclosure.
Exactly.
So you spend a lot of time together at home, right?
Exactly. So I think we're the only husband and wife duo on the ASX.
Take it, own it.
Yeah, I think so. And yes, as you said, Ian, we have our headquarters in London, and it's actually Miles and I spent more than 2 decades in London with our team out there managing the Global Value Fund from there. Our headquarters are still in London, but Miles and I actually relocated to Australia in November last year to set up the Asian subsidiary of the business. So we wanted to focus a little bit more on the Asian time zones. Right. We have done trading in those spaces before, but it's always been quite difficult from London time zone. But the Asian time zone would be easier from here. So
it's a really interesting kind of part of the world, lots going on, lots of opportunities. So.
There is, absolutely. So we are located here at the moment, and then we've got our team, the majority of our team in London. There's 5 of them. In terms of the company itself, the Global Value Fund, or GVF, We listed GVF 9 years ago, almost to the day. So it's been going for 9 years, listed in 2014. The IPO mandate of the Global Value Fund was to deliver global equity market-like returns, but to do so with a much lower risk profile than a traditional, basket of international shares. So far, I'm pleased to report that the company has delivered on that IPO promise and has annualized at 10% per annum since IPO in 2014.
Wow, that's good.
Yeah, and in terms of the downside protection, we haven't had one down year over the entire 9-year period. So hopefully protecting shareholders.
Hopefully, I mean, it's much easier to look back now, but when we launched, that was the promise we made to everyone, and with 9 years of track record, it's nice to show it's come together.
Exactly.
Right.
Exactly.
A good start. I'm going to test my tech capability here.
Okay, yes,
I just go run a few slides.
I'm going to support you from here.
Good idea, thank you. This is just to, I may push twice.
There you go.
My slides going? Okay, hope they are.
Yep.
Just going to run through a couple of slides that are on the screen, just paint a picture of the market. This is at the end of May in terms of the market cap, which sits around just about $50 billion, with listed investment trusts, which are also closed-end structures like listed investment companies, accounting for around about $9.6 billion or 20% of the market. That's where a lot of growth has occurred over recent times with the trust structure, but it's good to see that the LICs continue to provide provide for the sector as well. One of the important facts that we talk about a lot is the diversification opportunities that a listed investment company or a listed investment trust can provide. The pie chart on the left-hand side of your screen is actually where the market stood in terms of the assets that were held in either of those two structures back in December 17, which is when the association started. Roll forward to the end of May, you can see the blue is looking a little less like 8 o'clock, more like 7 o'clock. That's Aussie equities. But you'll notice the growth in global, which is the yellow piece, as well as that fixed income slot I talked about earlier on, the gold or bronzy piece at the top. So I guess the point here is there's a lot more to listed investment companies and listed investment trusts than Australian equities. Whilst that's important and the value held in the LIC or LIT space of those assets has remained constant. Growth is coming from other areas. Another thing we talk about is returns, and I'll come to the second slide in a second. But as you can see here, the bar charts mark the share price returns. The blue piece is the cash component, and the orange piece on top, the snow cap, if you like, represents franking credits. The grey line that's snaking its way through there in this particular slide is the ASX 200 index grossed up for franking. So the point we're making here is this is a look at the sector on a market-weighted average basis, is that if you choose and construct a portfolio correctly with an LIC or an LIT, you have the prospect of actually increasing returns above what the index yields. And of course, most of us would be aware that not every stock in the 200 pays a dividend, let alone pays a fully franked dividend. Now, the next chart is actually the weighted net tangible asset premium or discount, once again, for the sector as a whole. And you can see that moves above and below the line, but more recently through to the March quarter, it's trading more at a discount than it has done over recent times. And that's probably a reflection of the market volatility. I'm not going to go there. These guys know more about NTAs and discounts than I do, but I'll just finish with one more chart in this. As with the first slide on the left, these bar charts reflect the returns from the global equity component of the LIC LIT sector. Same principle. Blue indicating cash returns with franking on top. Hang on, we're talking global here. How do you get franking out of the global investment? I'm sure you're going to give us a little bit more insight into that. And then again, the two yellow and grey lines snaking along the bottom, they are the MSCI and the S&P 500 index. So again, you don't get much franking out of either of those, and typically they reflect investment styles that are quite different in overseas markets, where it's more about growth rather than income. Australia is almost peculiar in a good way in terms of the income the market generates. So I'm going to leave that as a bit of a scene set and pass over to Miles. You guys are experts in LICs. Give us a little bit more insight into the interesting facts about GVF and how do you go around the world looking for opportunities and ideas. And I'll just close this slide, and you've got some slides. We'll come back to that in a moment. Over to you guys.
Yeah, well, so I guess maybe I'll start off. We are a bit different. It's a very differentiated strategy. So, I mean, I think the key thing to remember when you're considering us or looking at us is we're not stock pickers. So our skill set is essentially finding discounted assets, cheap companies all around the world, and then unlocking the value from them. So instead of trying to outperform the market by, trying to pick Coles over Woolies, we look for ways we can invest into the market at a discount as a whole. And then the way we look to outperform is by unlocking those discounts through a big variety of tools we have, one of which is shareholder activism, which I think we'll come on and chat a bit later. If we're successful in doing what we do, what we're trying to give shareholders is two sources of return. So you get the returns from the assets we bought cheaply, and then you get this second source of return that we get to strap on top, which is unlocking all the value in these propositions that we find around the world. As Ian alluded to, I mean, there's a bit of an irony to what we do. So GVF is a listed investment company, which is a form of a closed-ended fund. We'll talk about that in a minute, I think. But we run a closed-ended fund, and the main thing we go and invest in all around the world are other closed-ended funds. So we know a thing or two about the closed-end fund structure, but what we like about closed-end funds when we're looking globally is it can often provide a wonderful opportunity to invest into asset classes or regions at a really big discount to fair value. And we're sitting in London with the whole world as kind of our investing playground. It throws up lots of really interesting opportunities for us. As I was saying, so we run a closed-end fund pretty successfully, touch wood, and we invest into closed-end funds. So if there's anything we know anything about, it's generally how closed-end funds work and what they're good for. But I will say it's not the only thing that we do. I mean, the key philosophy for us is finding $1 for less than $1. Places we can buy $1 worth of assets for a lot less than $1. And that mindset of buying cheap assets, we can apply to closed-end funds, but we also apply to REITs or holding companies, listed stocks sometimes, or even debt pieces or debt instruments we find around the world. Anything that's trading well below fair value and where we can see a path to taking that value out, we're often where we can be the path to taking that value out. So I think that's probably a quick snapshot.
That's great. Thank you for that. And just a reminder to our audience, you have the facility to type in questions. Please do that as we go through the presentations.
Yeah. Yes.
That way we're not sort of getting a run at the end. But Emma, do you got anything to add to what Miles is saying?
No, yeah, what I would say is we go around the world looking for this value. And I think we, as I said, we target these global markets, global equity market-like returns over time, but with a much lower risk profile.
And that's really the pitch. So we're trying to generate share market-like returns with a lot more downside.
Exactly.
You've got some slides for us.
I do have some slides, actually. I do. Okay, so.
If you can click on just above that. No, there we go.
No, you do it.
I'm
Ian's the expert.
I'm an expert. Once over, there we go. We're up and running. So just click onto the screen and you're away.
Okay.
Me just talking about the world.
Yes, that was Miles talking about the world. And then, okay, so for me, so it's all very well saying that we target these global equity market-like returns, but we do so with a much lower risk profile. But the question is, well, how do you do that? How is it that you are able to do that? Well, I guess the thing that I would say, Miles referred to two sources of returns. And I think if we talk about the first source of returns, which is the market exposures that we pick up, you look on the screen here, and what you'll see on this left-hand side is a pie chart of the underlying asset classes. So the underlying assets that we hold on a see-through basis, going around the world, purchasing discounted assets. And what you can see from this slide is that, we're only ever partly invested into global equities.
Which should be one of the higher risk, high reward kind of asset classes.
Absolutely. But then the rest of our portfolio is very diversified in a whole load of other assets. And that drives down the risk through diversification. What happens by investing into assets all over the world, we also end up holding a basket of currencies. So we're not trying to take currency bets. We know that our skill set is in the ability to unlock discounts. So we're not trying to bet currencies, but rather we hold a portfolio of currencies that again is very diversified and adds to that driving of risk down in the portfolio. To take this further and to further kind of illustrate what I mean by this, what I've done is I've taken these two pie charts, so the asset classes that we're invested into, the assets that we're invested into on the left, and the currencies that we've picked up on the right, and I've attributed these out in graphical form since IPO. So if we look at the graph here, this bottom dark blue wave is the asset classes that we've picked up or we've been exposed through time since our IPO.
Returns those are generated.
Exactly.
Yeah,
exactly.
The first source of return.
Exactly, the first source of return. So we've gone around, we've purchased a discounted asset. That asset has invested into various different assets, and these are the returns that we've picked up there. Then this next wave is the returns that we've picked up from the basket of currencies that we've held through time. And as you can see here, you know, when you have a low risk portfolio of assets and currencies that you're holding, you expect a conservative rate of return. And that's exactly what's happened here. You know, we've annualized there maybe 5 to 6% per annum. And that's how we've kept the risk down. The way we've then achieved those higher returns, so that 10% per annum, is we've strapped on top all of the outperformance that we've had unlocking the discount.
So that's the share price coming up.
Exactly.
From where you've been able to work.
Exactly, to meet the NTAs. And I think that is how we've created this portfolio where the underlying risk is lower, but the returns are comparable. And I go back to the numbers that I mentioned earlier. You know, we've annualized at 10.7% per annum, and we've done so on that lowered risk profile. There's two sides.
Because sometimes it's not clear that 10.7 is after all.
That's true.
That's a net return.
Yeah, absolutely. Yeah, we always talk net of fees and expenses because ultimately that's what ends up in the shareholders' pocket. So for us as well, I mean, just the other side of the coin and worth mentioning is the fact that, you know, because GVF runs with this lower risk profile, you know,
it cuts both ways.
It cuts both ways.
Yeah.
And so what does that mean? What does that mean? Well, I think the last 2 years probably do a really good job of summarizing us. In FY 2022, everything fell across the board. It was a grim time. It was a grim financial year. Global markets in Australian dollars were down 9%. GVF was up 3%. For FY 2023, global markets are running hot again. To the end of May, global markets are up 17%. GVF is up 15.5%.
So when markets are running hot, we won't keep up. We're just not carrying enough risk. But you on top of that, lower risk profile, we're strapping on our performance. And last year, hopefully, demonstrates why you want a bit of diversification.
Exactly.
So we're talking about your performance, how you go about getting it. Can we drill down a little bit further to see what is activist investing? Are you out in front of the buildings with placards? Are you trying to get the boards?
Or do you like doing that once or twice?
Yeah.
I'm going to say.
Tell us a little bit more about how you actually work with
sure. Okay. Well, I'll just say broadly, there's two sides to the business. There's a trading side of the business that's very special IP for us that we're very protective of. But the other side of the business is it generally revolves around shareholder activism, and that's quite a big concept, quite a big topic, and it's pursued by different people in different ways. But I guess when we think about activist investing, and what we've always stayed true to is essentially we're trying to solve problems. If we can turn up to a situation, buy a company or an asset as cheaply as we can, as cheaply as we do, buying things at 60, 70 cents on the dollar, something's not working. There's been a failure in corporate governance. Maybe the trustees or the directors have lost sight of what they're supposed to be doing for shareholders. Or maybe there's been a failure in management strategy or even the delivery of management strategy. But when you're buying something well below its physical breakup value, something is clearly not working. We come in very constructively, we're not cowboys, and we're there with a lot of, doing this for nearly 20 years now, we turn up with a lot of IP and experience, and we're trying to solve problems. And most of the time, that can actually be done in quite a collegiate way. We'll engage with all stakeholders, shareholders, managers, directors, boards, and try and bring about positive change. Sometimes it requires a little bit of an arm wrestle behind the scenes, but almost always we're able to walk away shake hands with everyone at the end, and everyone's better off. We've released value for our investors, but for all shareholders on the register, and that's what everyone should want. Unfortunately, that's not always the case. You do come across situations where there are vested interests. There's often lots of money at stake for directors and managers that they don't want to part ways with. And when we come across situations where it's clear that the people in charge are not acting for their underlying shareholders or investors, we get quite religious. We're a small independent firm. We don't have any of the kind of institutional ties around town that stop us from speaking up. And whilst we never enjoy doing it, we're also not afraid of firing directors or even winding companies up if it's necessary. We never set out to do that, but sometimes there's vested interests at play that really lead us with no other choice. But by and large, it's about turning up to situations where there's a problem and working to fix it. And really, everyone wants it fixed.
And you'll take a stake in the position.
We'll take a big stake in the position. We're there alongside everyone. We're not trying to do it from the sidelines, and we live with the result ourselves.
Have you ever been represented on boards of those companies?
Yeah, no, definitely. We often put directors up. I've served on the board of one of those companies. Some people might remember Blue Sky here in Australia. It was quite a mess for a while. I joined the board of a Blue Sky leak here in Australia, and I think was quite instrumental in rebooting that company. But we're quite, it's quite a common part of what we do is adding and removing directors when necessary.
So you're a fan of the LIC structure. I'm guessing that's not only because of the ability to retain those assets, give you the time to work with those companies, work out your strategies, work with them, get the result you need, give us that red outcome there. But listed investment companies have been around for 150 something years in the UK.
Yep.
We just ticked over a milestone here of 100 years. They've been around for a while, but what makes a good LIC? What would you say that you might go in with a different set of circumstances? What's the outcome look like in terms of the best possible outcome?
What makes a good LIC? I mean, I think that what's unique about the structure is, and maybe I'll just quickly differentiate it for our audience between, say, an open-ended structure.
Yeah.
But I think the unique feature is that it's a closed pool of capital. So instead of when you essentially raise capital from shareholders or unit holders in some sort of initial public offering or capital raising, and then after that, the capital stays within the vehicle. If shareholders want to add to their investment or redeem from their investment, they buy and sell units on an exchange. They don't take money back or give money back to the manager. And that closed pool of capital gives you a lot of flexibility to do things that are a bit different to sort of a lot of the vanilla unit trust structures you might see around town. And you talk about the structure being around since the 1800s. The very first closed-end funds were used to fund the railways in the US.
Right.
So if you remember the big railway craze in the 1800s, they were listed in London. And if you think about that, I mean, if you're trying to fund something as big as a railway and someone wants to add to their investment, you can't just take another $50,000 from an investor and build 2 more meters of a railway track, or if they want to redeem, tear up 2 meters of a railway track and give them back $50,000. You need closed pool capital, very sticky. So I mean, and what's been wonderful over the 150 years is the structure's really morphed and evolved to suit what capital markets need at any given point in time. The key difference with an open-ended fund, and here in Australia they're generally unit trusts, is when people subscribe, the size of the fund grows. So you get some more money into the fund goes out and buys assets in the market, or if you want to take money away, you sell shares or assets in the market and give money back to investors. Perfectly good strategy, perfectly good structure for some strategies. But what we love about the LIC strategy is that it opens up, especially for retail investors, it gives them access to lots of more sophisticated strategies that are typically only available to big institutions.
Do you think they realise that with respect to those investors? Sometimes you'll find a company trading at a discount, including listed investment companies, they're actually implementing these longer-term strategies with longer-term thinking. People tend to be a little fixated on short-term outcomes, short-term. We look at it every night on the news. The market was up or down. How did that affect my super? I don't think it did. But if I allowed my investment to mature over time to work with the professionals and the experts, is that the outcomes you're looking for, both in the investment you make as well as in the company you run?
I mean, for the company we run, I'd say that's definitely true. It gives us a much longer-term perspective. In terms of, using the structure, I think it's definitely the case. So, look, a good example is in the UK in the last few years, there's been a big push for a greener environment, and lots of closed-end funds have turned up, and their mandate, a bit like building the railways today, their mandate is to build solar farms or wind farms or all these kind of great things. And it takes you years to build a proper solar farm, and it takes you decades to get a return on that. So I think it's a very flexible structure that for the right kind of product is well suited, and yes, it lends itself to more longer term kind of investing.
There's some benefits for investors, obviously, in all of this.
Yeah.
I don't know what's your take on that.
Well, I think, just to reiterate what Miles was saying, I think that it really does depend on the strategy, and I think that that's an important part. But in terms of the benefits, well, there's a large body of academic research that shows that closed pools of capital, like a listed investment company, generate better investment returns over the long term. And there's a few reasons for this. I mean, Miles has covered some of them, but one is definitely, the first is that with a closed pool of capital, the investment manager doesn't have to sit on large pools of cash
to meet redemption.
Yeah.
And cash drag can really impact investment returns over a long investment horizon. So that's definitely one benefit to investors. The second is that, the portfolio management team, as Miles said, can focus on the long-term performance of the investment as opposed to, the short-term. Often in bull and bear markets, there's a lot of emotive investing.
Yeah.
And that's not necessarily the best thing for investors. So, for example, if the market crashes and people want to get out, well, you've been forced to sell assets.
Historically, the worst time to sell shares is in the middle of a crash, which an open-ended fund has to do.
Yeah.
Yes. Whereas, and the same works in reverse. When we have a very hot market, arguably a lot of hot money comes into the fund.
Absolutely.
And so,
perhaps less value.
Exactly.
You probably might not want to be investing your capital at the peak.
Exactly.
But you have to if you've got open-ended money.
It just gives the manager that, it gives them the ability to operate for the long term. And I think also, as Miles said, there's just certain strategies that just wouldn't be available to retail investors without it.
Slightly off topic, but even equities, to your point, very much so. That grey line I showed very much at the outset, that's the return of the 200.
Yes.
As that runs hot, you're giving money to a manager in an open fund. They're out there buying perhaps overvalued stocks.
That's the point,
and
yeah.
reverse on the way down, undervalued stocks are forced to sell as people try and redeem their money.
Yeah.
But with the strategies you have, and even with an Aussie equity strategy, retain that value within the entity and letting investors trade amongst themselves on market as they would a share or another listed trust is the way the LIC works.
And I think that underpins that academic research Emma was talking about. It's a well-trodden field that if you sort of give the same manager a closed pool of capital and open pool of capital, historically the closed pool of capital outperforms. You don't have the cash drag and you don't have that feature of forced buying and selling.
Good point.
Let's just wrap up on our discussion around LICs. You guys are involved in this on a day-to-day basis. These and others, are there other ingredients that make a good LIC?
Well, I mean, absolutely, always. We invest all around the world, and we love the Australian market. We run a LIC here in Australia, so we're very fond of the Australian market. But it is, to be honest, quite a small market. Canadian, US, Europe, Singapore, they have much bigger LIC markets. But in an Australian context, I guess it's probably three things that are really important.
Yeah.
The first has to be obvious, which is performance. We live, especially as an active manager that charges active manager fees, we live in a world today where passive has been a great benefit for investors in the whole. It solves a big problem for a lot of people. And if you're not doing what you say you're going to do in a closed-ended fund, it's very hard to justify asking shareholders to come into your vehicle. But assuming you've got the performance and you're doing what you can say you can do, I think the second probably most important thing here in Australia is yield. I mean, in an Australian context, and this is a bit of a generalisation, but most people that own LICs and LITs in Australia a bit later on in life and are using them generally to generate some form of income. And you need to respect that. If that's what your investors want, and that's what you've got to deliver on. Too often managers are very keen to hang on to AUM and not want to pay any out. We've always taken a view that our returns are your returns, we'll give that back as a dividend. But so I think performance, yield, and then
probably engagement, shareholder engagement, making sure that, Miles and I, we spend a lot of time speaking to anybody who wants to talk to us about the returns in their fund. It's their money, whether that's a farmer in Outback Victoria or, an IFA in Launceston. Everybody gets treated equally. And I just think it's so important to make that effort with shareholders.
And IFA being independent financial
IFA and British
speak, financial planner, Australian speak. And And I think the good analogy, we were chatting in the drive-in, a good analogy is like you're running a publicly listed company. It comes with a much more necessary marketing presence.
Yeah,
and again, you have to respect that and do the work.
Yeah, yeah, that's true.
I know you've got a couple more slides.
Mm.
Do you want to touch on those now or a little later?
No, we can touch on them. We can touch on them when you're ready.
Well, you want me to do the clicker?
No, it's okay for now, I think.
Okay.
Yeah, all good.
So that's a background. Let's turn to a little bit more detail about how you actually came to be involved with Global Value Fund. Your background.
Oh, me?
Yeah.
Okay.
Yeah. We're going to get to the husband and wife, raising a family, moving from London, enjoying the Sydney weather, but a little later. Tell us how a little bit of your background.
Okay, so yeah, I first met Miles in January 2009. We were both a good decade into our careers by then. He was working for a hedge fund. I was a director at Citigroup. And we started a life together. In 2011, I set up my own company, Affinity Capital. And Miles was with me every step of the way. You know, he was excellent at helping me make the transition from an investment banking trading floor to literally a startup with one of my best friends who'd worked with me at Citi. I'm proud to say that Affinity did well quite quickly, which was great. And when Miles subsequently launched GVF in 2014 and then Staude Capital in 2016, you know, I was there to support him in return on the sidelines. But it was, you know, a great way for us to kind of get to know one another. By 2016, we were planning to start a family, albeit very late. In life, exactly. And for us, that kind of meant choosing one or the other, you know.
Businesses, not family.
Oh, yeah, exactly. Businesses, exactly. And, you know, making such a big decision in terms of which business to support is never easy. But, you know, for me, I had watched GVF and the Staude Capital team from the sidelines for a while. And the more I saw, the more I liked it. You know, Miles and the team were genuinely different. They were adding tangible value, and it was something that I could really kind of buy into. And even the savviest of investors couldn't really replicate. So we decided to support GVF and the Staude Capital.
You mentioned the team, and there is a team.
Yeah.
You're here in Australia.
I mean, this is the small Australian subsidiary. A much bigger team.
This is a growing opportunity. We're going to come to your Asian opportunities, Australasian opportunities in a moment. But just to give us some sense of who actually forms part of the team, and you've got your slides up.
Yes, no problem.
Well, look, I feel really lucky. I think we are really lucky. At this point, we've been going for quite a while. We've put together now a team that, you know, fantastically close-knit, work really hard, really dedicated. I think there's 4 investment managers. And just to come back to our strategy a little bit, I mean, I think it's quite unusual to have an investment team of 4 managing the relatively modest amount of value we do. And it's a feature of, we have this rather niche strategy. When we find a target, we put a huge amount of resources into it. More typically at a larger, more traditional fund management firm, you might have 1 or 2 people managing billions. We have 4 managing a couple hundred million. So 4 of us on the investment side, Mark, Marius and James in London, and then myself here in Sydney. James and I joke, sort of is my original married wife. We worked together.
married.
My work wife.
Work wife.
I've been doing this for nearly 20 years together. James and I worked at a hedge fund together for 10 years. We started studying together. Mark joined us nearly 4 years ago now. Very senior hire. It's been a decade working for one of the big investment banks in London. And Marius joined us a bit over a year ago now.
Yeah.
He's only a few years out of university. Mark and Marius are both mathematicians. Marius has just finished a degree at Oxford. Mark did a master's degree at Imperial, so they're far smarter than me. But it's a fantastic team. We all gel together really well, which I really enjoy. On the business side, Emma's the CEO, so Emma's the boss at home, and Emma's the boss in the office.
Oh, please.
You don't know your place in the pecking order. And then
if only he'd listen.
And then supporting Emma, we have a very energetic lady called Emma Beard, running middle office. And more recently, we hired another senior lady, Debbie Tanner, who's our COO and CEO.
Emma came with me from Affinity, so she's been with me a long time as well. Yeah.
So as a company companies have boards of directors and directors and chair people.
Yep.
Yes.
Tell us a little bit about this. So you're operating out of the UK,
Yep.
But you're listed here in Australia.
So the management, most of the money's run out of the UK, with me kind of overseeing it from Australia and doing the Asian investing. But yeah, no, I mean, again, we're quite lucky. I mean, we've got a tremendous board that have been with us since IPO. So have a huge amount of embedded, institutionalized knowledge about what we do and how we do it. The chairman, Jonathan Trollope, a long career in Sydney as a corporate lawyer, which is a fantastic skill set to have at a board level. But these days, with so many things going on, he's a wonderful resource. Chris Cuff, many of you would know, famously took Colonial First State from a little startup to the biggest fund management operation in Australia when he left. And then more recently, he does a lot of philanthropic work and funds management work, and he knows the funds management world and fund managers really, really well. He's a fierce shareholder advocate, so he's a fantastic kind of independent director to have on the board. And then lastly, Jeff Wilson, who again, many of you will know, he runs Wilson Asset Management. I'd say without a doubt, that's probably the premier listed investment company franchise in Australia, a dozen or so LICs that all do very, very well. And that knowledge of the LIC market in Australia, again, is a wonderful asset for us to be able to draw on. And then at the end, there's little old me. I always feel a bit of a fraud turning up to board meetings with those guys. But I've been there since 2014, and I think we're very coherent, very focused on shareholders.
I've been to one of the shareholder meetings. In fact, in the AGM, it's a very comprehensive board. It looks tremendous. Great board, all here in Australia. Is that the reason you chose the ASX as a listing venue?
Wasn't the only reason, but it definitely helped. I mean, truthfully though, I think we both knew that GVF could potentially be a lifelong commitment if shareholders wanted that. And so, we always knew that we wanted to come back to Australia. In fact, Miles has been talking to me about returning to Australia pretty much ever since I met him.
Look at winter.
I know, exactly. And listen, having spent the last decade traveling this country, he was totally right. So it's an incredible place to be.
Pleased to hear. So we've heard about how you've structured the board that sits behind the portfolio, the guys running the stuff here and overseas. How have you performed? How's your strategy turned out?
Yeah. Well, yeah, I mean, has it delivered? Is the question really. And I'd say yes. I mentioned already that since the IPO, after all fees and expenses, GVF has run with 10.7% per annum. And while this number is great, and I do think it is impressive, it's not actually what has impressed me most. What has impressed me most about GVF is the tangibly lower risk profile that the company has exhibited throughout that time. I talked about the last 2 financial years and how those had fared, but another very clear illustration that I wanted to share is this graph here. And this is a very skewed graph, and what it shows you is every single trade that GVF has ever done.
So these are positions you're taking to.
We've taken or taking
over 9 years. It's
exactly.
Quite long.
It's a long period of time, and each one of those bars is an investment. Whether it's open or closed is kind of irrelevant. It's just a trade, if you like. And then what it shows is the profits on the left-hand side of those investments, and then the losses on the right-hand side. And what I love about the graph is, to me, it tangibly shows that lowered risk profile, meaning, when we make money for investors, we're able to make money. But most importantly, when things don't go our way, and that's inevitable, they don't hurt the portfolio too much. And I think over the long run, that has a real compounding effect on someone's savings. So, yeah, I'd say that's probably.
Downsides, we've got to talk about.
Yeah.
This. You've mentioned down years, but the structure and what you've been seeking through, has there been stuff you need to tell us about?
Yeah, sure. Oh, look, there's always downsides. I mean, running a small fund with a niche focus like ours has its drawbacks. The small size means that the running costs will always be on the higher side.
We don't have the economies of scale of BlackRock.
Exactly. And just to mention those fees, GVF charges 1.5% per annum in management fee, and it also has a 15% performance fee. although it is worth mentioning that the company sets a very high hurdle on the performance fee. It's currently 7.1%, and there's also a high watermark to keep things fair. Another factor to consider is, Miles mentioned GVF is currently 200 million in size now, and we're on record saying that we won't grow the companies any more than 300 million. And that means, and the reason for that is we want to make sure that we can deliver the returns that we have delivered so far. And we feel that keeping ourselves, quite niche and boutique is the way to do that. That said, when you are that small, there can be limited liquidity. So it is just worth bearing that in mind, that, liquidity.
And that does play to the mindset of your long-term investment thinking, your long-term investment strategies, and your investors and owners in the company need to sort of parallel and match up with that.
Exactly.
They need to have a long-term view. As
Yes.
I said, it's not about what's on the news tonight. It's
Yes.
about what's going to be on the news in 4 or 5 years' time.
Exactly.
And
I mean, there's no way we could generate that kind of win-loss ratio without the structure that we're using today.
Yeah.
And those returns you talked about earlier, they're all net of those fees.
Yes, so 10.7% per annum net of all fees and expenses.
And that's always the way to look at it. It's sort of performance after fees.
Yes.
So great stuff. Miles, you touched on earlier on yield.
Yeah.
You mentioned some of our audience might be interested in this, so I figure they are. So how have you done in that regard?
Well, I'll start with the philosophy. Our philosophy is essentially everything we make as investment returns, we will pay back, or we will pay back as yield to shareholders. So we've paid out, we generated 10.7% per annum, and we pay out sort of 8 or 9% as we go. So essentially, and we do that because we think it should be shareholders' choice about whether they want to take the income as the investment returns to fund their retirement or to use to live on, or if you'd like to reinvest the returns, then it's very easy to turn on the dividend reinvestment share and see your shares compound through time. But our default is we'd rather give the choice to our investors. So I think we've, because we've had the returns we've had, we've managed to pay a very consistent and gradually growing stream of fully franked dividends, or largely franked dividends. The yield today is currently about 9.6 cents per share fully franked we're paying.
It's 9.6
cents per share, and the yield on a grossed up basis is north of 8% today. And again, we're able to do that because we've been annualizing returns a bit over 10. And that will always be the philosophy for us, to pay out everything that we generate.
Right. So though you would have some retained value on your balance sheet by way of profits and the associated franking credit with that, which is
that's a good point. Yeah, I mean, that's one of the wonderful things about a LIC. As a company structure, you can hang on to profits and smooth the payment of dividends. So as I said, at a high level, if we're paying out about 8% a year and we're annualizing a bit north of 10, there's a little buffer that we keep in there, which we keep for the touch wood for the leaner years, and also to build up the profit reserves. And as it is of today, we've got 4-year profit reserve built up, so we could continue paying the current dividend run rate for the next 4 years without making another cent of return. So obviously, hopefully that wouldn't be the case, but we've built up quite a nice big profit.
And this slide here, just on the screen, shows all of the dividends. It's similar to you. So we put the dividends in, and then the franking is the grey on the top. And just to mention, we paid out, I think, 70 cents on the dollar that we IPO'd on.
Just to show we've given it all back.
It's a huge amount. Yeah, it's a huge amount paid out. Yeah.
Lee, I'm not sure if we have questions coming in from the audience. I'm happy to go to some of those for the moment. If not, we'll keep chucking along.
Yeah, thanks, Ian. We've got a few questions here. If I can jump in and we can share those. If you do have a question, make sure you're typing it into the question tab. Some of these you may have covered, but might be worth going over again and making sure we get some clear language around it for the audience. Linda would love to know a bit more about the metrics you're looking for to confirm the value in the companies that you're looking to invest in.
So that is a big topic that I could spend a long time talking about. But I mean, there's probably 2 buckets. The first bucket is where it's clear and easy. So if we're investing in, say, a closed-ended fund, like say an Argo here in Australia, Argo Investments or an AFIC, and that underlying investment just holds a portfolio of listed liquid instruments like shares, it's very easy to know what the underlying asset value is. We will build big sophisticated models so that we know the underlying asset value at any precise second of time during any time zone around the world. But essentially, everything's listed, and you can you can build a model that tells you at any point in time what the breakup value of the company would be. So that's probably half of what we do. The other half is more complicated, and part of the reason for having big teams. So when we look at more esoterical assets like private equity assets or debt instruments, we will have to roll our sleeves up and do a lot of underlying work in terms of fundamentals. But essentially, I think the thing to remember is we're not going into situations where we go, oh, I think BHP is cheap because I've built a big fancy DCF model and I forecast all these future earnings. We are always going into situations below breakup value. So the worst case scenario, we're buying something below the asset backing that you could sell all the pieces for today. That's an ironclad rule for us. Just some of the things are slightly more esoteric in determining that value, but it's never kind of an unknown quantity for us.
Great. Thank you. Another one, Lee?
Yeah, absolutely. Yeah, we've got a few more. You know, a lot of attendees and of course members across the ASA are always interested in chefs that eat their own cooking. So how much of management's total family assets as a percentage are invested in the LIC itself?
So I think we own about 250,000 shares, and I think it'd be fair to say we're kind of at that, we're still in the building phase of our life. So we've got a young family, we're trying to get on the Sydney property market. So outside of the deposit for the house and a little bit in our UK pension, essentially any spare money goes into GVF.
Yeah.
And you'll see us on the screen buying shares in sort of 5,000-10,000 clips from time to time. We've got about 255,000 shares.
Yeah.
Interesting perspective. A lot of people are going through that conundrum right now. Do I save for the house, the deposits, I've got to pay mortgage repayments, do I invest? I'm hearing you doing both, which I think is the right answer.
Yeah.
But, it's just a personal perspective. Well done to
you. Yeah.
No, it's not easy.
No, it's not. Well done. Next question. Will there always be underperforming companies for you to target?
Yeah, I mean, I get asked that question a lot, and I guess there's probably two ways to think about it. Conceptually, yes. I mean, for every, markets are essentially, for every winner there has to be a loser is a little bit of a rule. So yes, there's always companies that aren't living up to what they promise people. And I think the other thing to mention, we actually haven't touched on this much, but we're quite wedded to the fact of staying small and nimble. I think one of the diseases of fund management is people chase size for its own status, own reason, and there's obviously an economic incentive to do that. The bigger the fund, the bigger the fees. We've been on record all along to say we never want GVF to get more than about $300 million, which is actually quite a small fund in the scheme of funds management. And we do that so that the guys and I turn up to work every day without the pressure of like, gosh, where am I going to put $1 billion today? It's like we get to cherry pick the most exciting things all around the world. And that we get really excited about them. So I think in terms of finding stuff to do, we've never, for the amount of AUM, the amount of money that we're managing, we've never not had a big long laundry list of things that we're excited about. And then what we get to do is sort of cherry pick the things that we're most excited about.
But I think 300 million is big enough to give you efficiencies.
Absolutely, the size and scale.
That's nice. That's a sweet spot for what you do.
And that's coming in terms of the size and scale of the league. That'd be a wonderful place to be.
Right.
But it's certainly very small in the scheme of funds management.
Yeah.
Back to you, Lee.
I'm going to roll up a couple of questions here, and hopefully this covers it. Are there any countries or regions that you perhaps are mandated or just subjectively wishing to stay away from? Perhaps their governance is not quite there. It's too risky in terms of geopolitical, tensions, things like that. And also, are there any particular regions that exhibit like lots of value at the moment? Perhaps there are a lot of companies trading at a discount that are interesting to you, and a small team need to cover a lot if you're scouring the entire world.
That is true. Why don't we? I'll say a few words, but then maybe you can say a few words on currency. If I remember some currency.
Sure.
But you ask a fund manager for a simple answer and you're never going to get one, but I'll try my best. I mean, I think the thing to say is in regions where corporate governance is ropey, you generally find things that are cheapest. So it is a bit of a trade-off. I mean, as a general rule, we will stay away from emerging markets and jurisdictions where shareholder rights are quite poor. but that's not an ironclad rule, and we'll often find situations in sort of semi-emerging markets, Korea, Hong Kong, or China, where the poor local governance and poor local strength of the law is weighed up against the fact that you're buying something at 40 cents on the dollar. There's a hell of a lot of value if you can see it through. So I'd say that those kind of places are the really higher risk, in our mindset, the higher risk, higher reward kind of opportunities. We certainly won't say no to them, but we're a bit more kind of, I mean, as hopefully has come across, we're very conservative and we're very determined to protect on the downside. So we stray into those places very rarely and with our eyes open, or gingerly is a good way of saying it. But I think one of the ironclad rules we have is on currencies, where when we might pick up.
Yeah, I mean, the currency wheel that I referred to earlier, the reason why we hold all of those currencies as we do, you might have noticed there was quite a big Australian dollar exposure. Now, that's not us holding Australian assets. That's more that we've maybe picked up currencies that we would deem to be kind of not developed market currencies, maybe a little bit risky, and we've hedged back into Australian dollars because obviously that's the lowest risk currency for an Aussie dollar company to hold. So I think that kind of gives you a sense of, what we might consider in terms of the more racy parts of the market.
So the philosophy is always to reduce risk wherever we can. So if we were to say find an interesting opportunity in a less developed country, we would generally take the Australian dollar, we take the currency risk out of it as one factor we can control.
Yeah.
In terms of, just to hit on it quickly, what's cheap at the moment, and smallish team navigating the world. To answer that second one, I have the luxury of having these really bright people. So Marius has come to us, ex-Oxford mathematics. He can program in all these great programming languages. We have these tremendous filters that let us cover the world very quickly. And to then jump to the first part of your question is, generally, and having done this long enough, I feel like I can say this, there's generally something going on. So generally there'll be some theme in Canada, and Canadian closed-end funds will be cheap for X, Y, Z reasons. In Australia at the moment, interestingly, the market is cheaper than it normally is. And our assessment, our belief on that is it's the end of the tax year. And we generally notice as you get into sort of May and June in Australia, a lot of the LICs and the LITs will see a bit of extra selling pressure as people tidy up their tax affairs for the year. And that extra selling pressure makes things cheaper for a few months, and it generally normalizes again in July and August. So arguably, this is actually quite a good time to be looking at LICs and LITs in Australia. So there's generally a theme going on somewhere in the world for us to chase.
Great. Yeah, thank you for answering that. I know it was a pretty broad question, so you've done well. The next one is, the next question we have is, what's the current NTA for GVF?
Yeah, sure.
Speak to them, maybe.
Yes, yeah, sure. So as of the end of May, the NTA was almost $1.20. Yeah. Yes, exactly, $1.20. Our share price is about $1.12 at the moment, which is quite unusual for us. I mean, just to give you a sense of GVF, looking at the average discount premium that we've run with since IPO, we've traded on average over that 9-year period at a 2% discount, so very close to our NTA. And at the moment, it's wider than that. It's closer to a 6 or 7% discount. And again, we think that that's probably down to the fact that we haven't been marketing as much as we would love to.
With the new baby.
But also the tax loss selling at the end of the year often has this effect on a lot of LICs. So, arguably it's a opportunistic time.
And one thing I would say, and I'm not trying to plug GVF per se, but when you're talking about yield and dividend income, which I know is important for a lot of the members of the ASA, one of the things that Ian was saying before, like they generally pay quite a high yield. And the great thing about a yield is the yield gets higher and higher the cheaper and cheaper you buy. So GVF's yield is obviously amplified by buying it a bit cheap. And there are other LICs out there at the moment that are trading, again, we think much cheaper than they normally do. And one of the neat things about that, if you have a longer term horizon, is you'll get a much better yield than you might normally do buying it at a different time of the year.
Yeah, it's great when you can pick up things for less than they're worth, right? That's the whole business. End of webinar.
If it was my wife would do it every day.
Well, there's no more questions that I've got here, Ian. You know, there's a couple of comments, perhaps if there could be a discussion around the internal fee structure or anything like that. And you know, if we could also get some contact details for anyone who would like to ask further questions maybe later on. Of course, if you want to download the presentation, it is in the handout section of the control panel, and it will be posted online later as well. But that general information for everyone viewing would be great, and I'll tune in right at the end.
Okay, so we've got time for a couple more questions.
Absolutely.
Okay, just a couple of quick ones, and we'll get them quick.
Yeah.
What's next for GVF? You're now based in Australia. You said Asia, and you've also mentioned discounted LICs trading in this sector. Are you visibly looking around Australia to Asia, to our near neighbours?
Absolutely. So that's a big. I mean, we've always done a lot of investing in Australia in the context of the global universe. So, you know, Australian investments today probably 20% of our portfolio, which is a lot larger than it would be, say, if the global market cap. And that's a function of, at the moment, you know, Australia's quite cheap, probably cheaper than some of the other regions around the world, we think, because of this year-end tax thing.
Yeah.
And then more broadly, I mean, some of the most successful investments we've made have been in places like Singapore, China, Hong Kong. They've been at the riskier end of the spectrum, that have certainly generated returns to compensate for that, if not more. And it's an area that we'd like to do a little bit more exploring around. And I think that's a big part of the reason for coming back to Australia.
I think, and in terms of what the future holds, I mean, honestly, if we can kind of replicate the last 9 years again, I'd be chuffed with that.
I think a lot of people would be.
Yeah, exactly.
Just to finish up on a more personal note, and thank you for being very candid about your husband and wife status and married and working together. Emma, and I'll read these quotes so I get them right. You recently contributed an article to the ASA Equity magazine.
Oh, yes.
Your first line was, "What is it like to work with your husband?" Shortly followed by, "How do you not kill each other every day?" Well, what is it like? And he's still alive. So that's the first piece of good news, just to wrap up on this.
Oh my gosh, this is such a big question. You know, to be honest, you never quite know if you go into business with your spouse or indeed any family member, and there are many business, I think the majority of businesses out there are family owned and run businesses. I'm not talking about the big conglomerates.
You mean in number?
In terms of numbers, yeah. But when you make that leap to work with your spouse, I mean, don't do it lightly, number one.
You learn a lot about each other.
You learn a lot about each other. And I think also, look, Miles and I have always prioritized kind of mental health, working on our strengths. We've always had coaches within the business to kind of help us to understand each other's strengths and use them to our advantage, because we are very different people. But I have to say, I probably wouldn't have it any other way.
That's great. Very pleased to hear.
Luckily.
I think we're right on time, but I'll just wrap up with a few quick thank yous. Thank you to joining us today and giving us that insight. And I'm saying that on behalf of the ASA, but to the ASA, thank you to you, Lee, and the ASA for facilitating these sorts of discussions. We, as an association, the Listed Investment Companies and Trust Association, really appreciate and are grateful for our relationship with the ASA. Tremendous conference back in May. Very pleased to have been part of that. You mentioned follow-ups. We had a slide, which I think is now available to those joining us on the PowerPoint pack. It's got a website link back to GVF. I know you produce a newsletter. There's contact us or find out more. There's plenty of ways people can get in touch.
We'll make sure our emails are sent through somehow. But yeah, any question, anytime, is never too small.
Exactly.
And I know you're very engaged with your investors and those that are interested. So personally,
we try to be.
That's tremendous. That's tremendous. And of course, small plug for LICAT, the Listed Investment Company. Our links are there as well, and there's a whole bunch of other information. So at the moment, thank you very much. Great to have been with you today. We look forward to the next occasion.
Thank you, Ian.
Thanks,
Thank you, Lee. Thank you, everyone.
Thank you, Ian. Thank you, Miles. Thank you, Emma. And thanks to everyone attending. We'll be back next week with another webinar. For now, enjoy your Tuesday, and we'll see you soon.